Hello and welcome to Structured Finance in Focus, a Fitch Ratings podcast that takes an in-depth look at latest developments across global structured finance markets. My name is Ben McCarthy. I'm Managing Director at Fitch Ratings and head up the analytical team for Asia Pacific for structured finance and covered bonds. Today I'm joined by Natasha Vojvodic and Chris Stankovski, who are Senior Directors in Fitch's Structured Finance team, which covers Australia and New Zealand. We're recording this podcast in the lead up to the Australian Securitisation Forum conference, which will be held in Sydney on the 2nd and 3rd of December. I'm told they expect well in excess of 1,000 delegates coming at a close of a year which has seen issuance at a record for both RMBS and ABS, and at the same time has seen post-COVID lows in terms of pricing. Natasha and Chris, welcome to the podcast. Natasha, I went back and listened to last year's podcast, and you'd be happy to know that the forecasts were remarkably accurate. You had arrears rising marginally, peaking in the second quarter, and you discussed the possibility of interest rates being higher for longer. And you also forecast property price rises of around 5% for sort of Australia nationwide. Congratulations on those forecasts. This year, I thought we'd try to have a bit of fun at the end of the year and play a bit of a game. We'd structure this that I'll make a statement and leave a blank and ask each of you to fill it in. It's fine. So whatever comes off the top of your head is fine as an answer, and we'll see how we go. So we'll start first. Maybe if we'll just do it in order. Natasha, if you go first, and then Chris. So first statement, 2024 structured finance will be remembered for blank.
Issuance volumes. This year will be a record year. We're already 41% higher than last year, which was also a post-GFC record issuance year. The new and returning investors came into the market and pricing tightened, especially in the non-AAA notes. Non-banks and those in the non-conforming space were the main issuers, but bank issuers also returned to the market at more meaningful volumes not seen since the beginning of COVID. There are also more private placements seen this year across both RMBS and ABS.
Well, thank you. And Chris, 2024 structured finance will be remembered for?
Yeah, for me, it's for more what didn't happen. So going into 2024, there was real fear around the fixed rate home loans expiring and that would cause mass defaults. Fitch's position was that wouldn't happen because you've got people on lower fixed rate loans for longer as opposed to gradually going to higher fixed rate earlier. And so that didn't happen, which was interesting and in line with our forecast. Also, there's a lot of talk going into 2024 that the high interest rates will lead to higher levels of default. Again, Fitch forecasted that wouldn't happen on the assumption that the unemployment remained low. And through 2024, we saw low unemployment levels. And in turn, we didn't see any significant increase in defaults due to elevated interest rates. And also in 2024, we've had a lot of economic uncertainties. There's been a lot of conflicts around the world, inflationary pressures. There's been key elections around the world. Although there's all this economic uncertainty in the background, as Natasha just pointed out, we've had a very strong year in structured finance. So I think for me, it's more what didn't happen in 2024. That was a highlight.
Thank you. If we just move to interest rates, interest rates are predicted to fall at some point in 2025, although they keep getting pushed out. As a statement, can you fill in the blank? Falling interest rates will cause blank. Natasha.
Affordability to improve, which will also mean more first-time buyers are able to come back into the market, increasing demand. And as the lack of supply still remains the main issue, house prices are expected to rise again. We're forecasting another 4 to 6% increase in prices next year, followed by slower growth following year as affordability constraints start to bite again.
And for you, Chris, falling interest rates will cause?
Yeah, I agree with Natasha, the affordability. For me, I can't see a whole servicing element here. So if interest rates were to start falling at the end of next year and fall slower, I think the benefit of affordability is not going to be enough to offset the people who have affordability problems and are high risk. But if it's more aggressive, absolutely it will. For me, 2024 has been the year of servicing. So there's been a lot of conversation this year about pressure on APRA to reduce the 3% servicing buffer for banks. While non-banks are currently at 2%, some of them as low as 1 to 1.5%. I see going into 2025 being election year, there'll be more pressure on APRA to make that reduction. And based on the counter-cyclical nature of the servicing buffers, you expect that if you were to reduce buffers, you'll do it at the top of the cycle. And some may argue if the inflation genie is back in the bottle, we are at the top of the cycle, so there could be an argument for that. But if these interest rates start falling and falling aggressively, well, the argument to reduce the buffer may disappear quite quickly as you start getting lower on the interest rate cycle. Another thing that I found quite interesting this year and interesting to look into next year is the non-banks practice with regards to servicing the like-for-like refinances. There's a caveat in the Consumer Credit Code that allows lenders to have lower servicing assessment for like-for-like refinances where the borrower has had strong performance history for the last 12 months, and by refinancing the loan, they get a lower rate. What we've seen, especially in the non-bank space, is that they've been servicing these loans with a 1% buffer. And we've had one lender who's told us never put a servicing buffer at all on these loans. So I'd be very intrigued to see how 2025 rolls around, and should the interest rates drop, what the position would be for this like-for-like refinancing. Will they disappear, or is that going to be a permanent part of the residential mortgage servicing in Australia?
Thanks, Chris. All right, moving on to investors. Investors may be unaware of blank. Natasha?
The impact of tighter pricing on credit enhancement. While investors are aware that the significant tightening in pricing means more excess spread in transactions, what they may not be aware of is the impact on excess spread in terms of potential credit enhancement. With more excess spread coming through to cover losses, this increases the soft credit enhancement available to note holders. But this may mean that issuers reduce the amount of hard credit enhancement provided by note subordination, all while maintaining the same overall credit enhancement and rating.
Yeah, interesting. And Chris, have you got something that investors might be unaware of, but maybe should be?
Yeah, mainly movement to structural features. I presume investors are aware of this, but it's worth pointing out. We've seen structural features move in Australia based on two main topics, being increased arrears and reduced bond pricing. So on the increased arrears fronts, we've had some lenders who have seen increased arrears. What they've tried to do to be able to tackle this in some of the deals this year was to widen the performance-based pro rata triggers, specifically the 60 plus or 90 plus days arrears. These performance-based triggers are one of the factors used to determine whether a transaction pays sequentially or pays principal pro rata. When the trigger is breached, the transaction has to pay principal sequentially, which essentially means that the most senior note gets paid down first before the rest of the notes. What this does, it has a positive credit impact where it builds up the credit enhancement for the senior notes, which we see as a positive feature. But for the lender, it actually increases the cost of the transaction, as the most cheapest note is getting paid down first, where you got more expensive notes hanging around for longer. And so in order to be able to deal with this, we've seen some lenders widen performance-based triggers, which will allow the transaction to stay in arrears for longer should they have higher. It will stay pro rata for longer should they have higher arrears. The other thing that we're seeing, which is more addressing the reduced bond pricing, is we've seen some non-bank lenders take actions in order to lengthen the transactions to be able to maximize the better bond pricing. And they've done this in two major ways. We've seen some non-bank lenders who typically have a 20% base call, reducing that down to 10% or in between that 15%, which will increase the weighted average life of the bonds. And further, in the same type of vein, we've seen that when they've had date-based calls, usually 3 or 5 years, they move that back to 7 years in order to maximize the time that this transaction will be out there with the better pricing. What we've also seen, because pricing's been good this year, is we haven't seen any Class A no refinance options in the deals. We've generally seen that happen when bond pricing is wider. And because of the tight bond pricing, we haven't seen that structural feature be prominent in this market this year.
All right. And just in terms of what to watch for 2025, Natasha, if you had something for investors to watch in 2025, it would be...
As was the case last year, higher for longer interest rates is a possibility. If you look at the economic indicators we look at in RMBS and ABS, economic growth has stabilised, with growth expected to improve next year to 1.7% and even better beyond that. Inflation is still at the top of the RBA band, and unemployment has been extremely low and has been around 4.1% for the last 3 months. Underemployment is still far below what it was pre-COVID. And as we've said, property prices have continued to rise and mortgage arrears are still very benign. And none of these point to a need to reduce interest rates anytime soon. But higher for longer interest rates may mean worse than expected performance, especially in those portfolios with non-conforming borrowers and high proportions of self-employed borrowers with low documentation loans. These borrowers are already paying higher rates and have experienced higher arrears than prime borrowers.
Thanks, Natasha. And Chris, for you, something for investors to watch in 2025?
Yeah, I think it's underwriting creep. So we've got the market set up essentially perfectly to get underwriting creep. You've got unemployment that's been low for record low levels for a couple of years now. You've got mortgage performance that's been quite resilient. And you've seen a lot of market pricing pressures in the market with lenders competing quite heavily in the mortgage space. And we've also started to see some creep with the like-for-like refinancing that I mentioned previously. But you're also seeing the minimum requirements for full doc self-employed loans shift over the last year, in the last couple of years, where previously a full doc self-employed loan would be considered full doc if it had 2 years of tax returns, where these days now it's 1 year. And so in this particular market, Fitch will be keeping a very close eye to see if there's any further creeps in underwriting going forward, and would recommend to investors that you should be quite aware of the underwriting between different issuers, as this may become more pronounced in the future as the mortgage business competition heats up in 2025.
Thanks, Chris, and thanks, Natasha. We might leave it there. And thank you to the listeners who've joined us. You've been listening to Fitch Ratings Structured Finance in Focus podcast. To learn more about our ratings and research on structured finance, or to access index reports that are referenced in this podcast, please visit us at fitchratings.com. For those attending the ASF conference in Sydney in the first week of December, please reach out to us so we can catch up in person. Please subscribe to our podcast on iTunes, Spotify, or wherever you get your podcasts. Thank you.